Welcome everybody. Thank you for joining us tonight. We're going to be going over divorces. We're going to be going over how mortgages are part of that, how credit affects all of that. So in front of you is this two-page document here. And these are just some of the commonly asked questions. And I know that each one of you have a specific scenario as well. And if you do have questions, just let me know. We'll address those. So starting out just with basics, what is a credit score? Credit score is a compilation of personal information, including dates of birth, social security numbers, addresses, names, and even aliases show up on that. And it's a report that's compiled for several different uses. For our specific use, we use it in qualifying people for home loans, for mortgages. And there are different types of scoring models out there. We use one that's called the Fair Isaac Model 2 that pulls the Fair Isaac scoring. With that, those credit scores range between 350 as high as 850. And so on here, on this graphic, you'll see kind of where the nation is based on certain brackets. And it's interesting because for us, anything over about 740 is considered excellent credit. Anything below 740, you start seeing adjustments on interest rates. And these are standards that Fannie Mae and Freddie Mac have set. There are three principal credit bureaus, Experian, Equifax, and TransUnion. Now, for you guys that are going through a divorce, or for those that were with us in some of the other meetings that we've had, as we've talked about this, it's really advisable for you guys to check your score at least once a year. And you can do that. Congress passed law that you can get that report for free. You can go to annualcreditreport.com. There's other places you can go as well. But that's the one that Congress mandated they set up and you have access to. So as far as what makes up a credit score, that second graphic down there below, the color-coded one, gives you an indication of what affects your credit, what gives us that score. 35% of it is based off of your specific payment history. 30% of it is based on your current level of indebtedness. So what does that mean? Your credit cards. If you have a $10,000 limit on your credit cards, if you're actually owing or carrying a balance above $5,000 or 50%, you'll actually start to affect your credit adversely. Does that make sense? A lot of people don't know that. They think, well, so long as I'm not over my limit, I'm okay. And you are from the credit card's perspective, but as far as your FICO score is concerned, as they report that information, that's one of the risk factors that they see. The higher those balances are, the higher those ratios are, the more likely you are that you're going to run into an economic event that could cause a default. So I thank you for coming.
No, certainly. I have a quick question on that.
Sure.
I don't carry a balance on my credit card, but they keep trying to raise my available credit.
Okay.
I know I've stopped it because I heard that having too much credit is an ability, they kind of look at it as an ability to go into debt. How much can you go into debt tomorrow?
So the question is, I have credit cards, I'm not carrying a balance, and they are trying to increase my available credit limits. So that can affect you, but not on your FICO score, if that makes sense. The FICO score itself, that actually is a benefit to you. From an underwriter's perspective, when you're applying for a loan, they see that as a potential risk factor, but they're going to look more heavily at that point at how your payment history has been. So, but that's a great question. You're fine to have them raise your limit. It's a matter of comfort for you. So, great question. Going back on that graphic, 15% of it is based on the age or the length of time that you've had your credit accounts for. So if I go and open a new credit card account for Sky Miles or whatever, that's going to hurt my credit because of the inquiry for starters. And then second, it's a new account that has no age or no payment history on it. So if you have older credit card accounts, even if you're not using them, If you're not using them completely, I mean, go ahead and get rid of them, but the older the account, the more weight that account carries with your FICO scores, if that makes sense.
Positive, negative weight?
Positive. Positive weight. Yeah, the older the accounts, just like a mortgage, for example, the older that is, the more stability in payment history that they're seeing. Yes, question?
Does income factor into your credit score anyway?
Great question. Does income factor into FICO score? It does not. Income has no bearing on what somebody's FICO score is. Really, the idea behind a FICO score is it tells banks, hey, this is a good guy to lend money to that we can earn interest on. I mean, that's really what it's for. So, and I work for a bank. So, but in all reality, that's it. Are you somebody that they know I can give you money and you're going to pay it back? So, 10% is based on the pursuit of new credit, so credit inquiries. Oh, yes, another question.
So my online credit card banking has a little calculator that says if you do certain things, we'll kind of estimate and give you an idea of whether it'll go up or down. I was just playing with this today, and it was interesting because it gave me a higher score if I closed an older account, and it increased my score if I opened a newer account. Now, I don't know
That's
if
interesting.
those little calculators are just playing games with my head or what.
No, so the question is, online credit card has an estimator, a credit estimator that you can put scenarios into, and it can affect your credit up or down based on a new or a closed account. Like I mentioned earlier, there are different scoring models, and so depending on which model they're using, that could in fact be the case. Generally speaking, when it comes to consumer credit, like I said, they're going to be weighing very heavily on credit and payment history. There's also a mix of accounts. So banks like to see, and I'm not just meaning for home loans, but I mean banks in general, like to see a mix of credit. So you have revolving credit, you have installment loans like car loans or student loans, and then of course the big one is the mortgage payment as well. That will boost credit very quickly. So they want to see a good mix. So somebody that is coming back from a bankruptcy or overcoming a foreclosure, or it's part of a divorce, there are things that can be done to improve credit scores, and we're going to talk a little bit more about that. One of the reasons that we wanted to present this class to everybody was through all the years of experience that Eric has and that I have, a very common thread that we see with divorce is credit goes from an 800 FICO score down to a 500 FICO score. And a lot of times there's a lot of reasons for it. One of the spouses gets upset and charges up a whole bunch. Another one refuses to pay it, and so they stop their payments. They're fighting over the house and decide not to pay those payments. There's a myriad of reasons. Our goal in doing this is to try and help educate people up front. If we can arm you with the correct information, you can be better prepared during the divorce process as well as after the divorce process as well. Yes?
So if all the payments are made during a divorce on the mortgage, right, you're not charging up, she isn't charging up, just by being divorced, that doesn't impact your FICO score at all, right? Correct.
Yeah. The question is, if all payments are made on time, does the fact of being divorced, does that affect your FICO score? And the answer is no, it does not. It really boils down to these key items that we've mentioned here. And we'll definitely have this graphic up on the video as well. So, any other questions before we move on?
When everything's paid on time, you're not behind anything, and you do, your divorce is final, and then let's say I wanted to go in and apply for a mortgage, and I mentioned the word divorce, are they going to want to see the whole divorce decree about what the income ratios?
Great question. So the question is, if I go in to apply for a mortgage and I disclose that I'm divorced, are they going to want to see the divorce papers? And the answer to that is yes. If it's a very old divorce, they may not. Or if you're remarried, they probably will not, unless you're obligated to pay child support or alimony. And if we turn on to the next page, we'll come back to improving credit scores. But if we go to the next page on here, you'll see a couple of these very specific questions. How does child support and alimony affect my credit score? As far as it affecting your credit score, just by virtue of you having to pay it, if you're responsible for it, that does not affect your FICO score. If you fail to pay it, and all of a sudden Division of Family Services is trying to get a judgment against you or garnish wages, then in fact that will affect your credit score, and it could affect your ability to qualify for any type of financing for a while. Part of the question in applying for a mortgage and qualifying for a new mortgage, if you're obligated to pay child support or alimony, that affects your debt to income ratio. We have very specific guidelines that we have to follow, and if you're obligated to pay it, we have to accrue for that. Now in the divorce decree, which is one of the reasons they're going to want to see that, is it'll outline how long you have to pay that for. And most times, once children reach the age of 18, it's done. Or if a previous spouse gets remarried, oftentimes it's done. One of the advantages in being armed with good information up front is that can all be part of your negotiations in the divorce settlement process. If, say, one spouse wants to maintain the house or keep the house for the kids, that is all part of determining how much child support and how much alimony. Because if let's say the ex-wife wants to keep the house and you have to pay child support and alimony, she may need a little bit more to be able to qualify and maybe even cash you out of your portion of the equity. So there can be some give and take in that negotiation. Or even for yourself, if you need to be able to qualify for a new house, and you need alimony to be lowered by $300 to do it, that can be part of that negotiation as well. So, any other questions regarding that? Oh, go ahead.
The only thing that's, I've set up an LLC to take, because I work out of my home as an office.
Sure.
So I've got a home office, and I'm also in the final stages of a divorce. And so a lot of that kind of fits into what you were just talking about there in terms of how do you recalculate, because the LLC, the business, is going to take on the business expenses, and then it will pay me a certain amount that's going to then be my next income
Correct.
level.
Okay.
So I don't know how that fits into this discussion so much, except that I don't know how it really affects. I'm curious about credit because I'm trying to stay out of debt. I don't want any debt.
Good, good. So the question is, how would an LLC or being self-employed affect this negotiation or affect qualifying?
That's a good way to put it.
So just by virtue of you being self-employed, from a lender's perspective, we are going to take 2 years, your most recent 2 years tax returns, and use that to calculate your income. You may make $200,000 and write off $150,000 of it and only show $50,000. Well, on a 2-year average, I'm only going to be able to use that $50,000 plus adding back in a few expenses like health insurance, for example. There are some costs that we can add back in off of your tax returns to increase that. Now, when it comes to the divorce, that's something that your divorce attorneys are going to have to negotiate, because there are true costs that you're incurring being self-employed. And if you're officing out of the house, there's some true costs there, right? That'll have to be factored in and negotiated through. There's not a set answer for that. But from the lending side, those are the guidelines that we have to follow when qualifying. So that's, like I said, that's all part of that negotiation up front. So does that answer your question?
It does, thank you.
As far as your concern about going into debt, please stay out of debt if at all possible. It's, especially being self-employed, sometimes there's up times, sometimes there's down times, and you have to bridge yourself. And having that noose around your neck with debt sometimes can be very, very cumbersome. obviously there's expenses. You've got to cover those as a business. But when it comes to qualifying, the lower the debt, the easier your ratios are, and the more you would ultimately qualify for, if that makes sense.
Yes, it does.
Okay. Any other questions on that topic at all?
Well, what if my wife's gonna stay in the house and there's no way she can qualify to buy me out?
Okay.
So my name's gonna stay on that mortgage and I'm gonna pay my fair share of that mortgage. How do I prove, if I wanna buy a house, what kind of legal document something needs to be in writing what I'm paying and what she's paying toward that mortgage?
So, great question. The question is, if I get divorced, my wife maintains the house, but she's not able to qualify for a new mortgage, how do I qualify for another house? Correct? The answer to that is you would actually have to qualify for both payments. So,
Both full payments.
Yep. Because regardless of her paying her portion or not, you are legally obligated for that full payment.
So you saying in the divorce decree, if we agree on terms that maybe she can qualify, meaning alimony, more child support, whatever, can qualify to buy me out.
Correct.
Then when that happens, then we renegotiate the divorce decree?
That's always a possibility to go back in and renegotiate some of those. So, but that's something that you and your attorneys will have to decide. That's the nice thing about the divorce negotiation. It could end up anywhere from being down low to being up high and anywhere in between. So you can decide what those terms are. I've seen it where people have agreed to keep the house and continue to be obligated for up to 2 years while perhaps their credit gets repaired. Perhaps they were late during that time and they need a couple years to overcome a bankruptcy, something to that effect. But at the end of that, they have to sell and they split equity at that point or refinance. So it gives them time to go ahead and figure out how they're going to qualify. And perhaps alimony and child support is part of that negotiation and projections. Does that make sense?
So you can project alimony and child support to go this level for a few years, she qualifies, and then bring it down?
You could, but again, that would have to be all laid out in the divorce decree. And as a lender, I'm going to look at what that divorce decree is stating. So here's the thing with child support and alimony. If the ex-spouse is receiving that child support and alimony, consistency is a key word in being able to use that. Just because a divorce decree says she gets $1,000 in child support, she can choose to disclose that when applying for a mortgage. She's not legally obligated to disclose it. But to use that to qualify, we have to prove that she's actually been receiving it and that there's continuation expected. So it needs to be consistent. So if in the divorce decree it's saying, well, you get $1,000 for the first 3 years and then $100 after that, if we're qualifying right up front, we know that we have a 3-year continuance, which is what they want to see. And if it graduates down, they're going to end up looking at that and determining how far out it is before they drop that amount, if that makes sense. So the divorce decree is very, very important when qualifying. So if one thing that we do, we are happy to come in and give you our professional opinion as you guys begin your negotiation process. We're happy to take that time. We don't charge anything to do that. We just hope we've done our job well enough that we win some business. But we do that for free. We do that to come in and help you guys because we know this is a tough time in your life. It's a tough time for everybody. And again, our whole goal is to get you the information to help you make the best decisions possible. Yes?
So you're saying that when a couple sits down to determine what their options are for staying in the house, selling the house and dividing the equity, or refinancing the house, buying somebody out, one person staying in the house and the other person hoping to buy a house, whatever that is, you're saying that you can sit down and kind of tell them, this is what a lender such as us would look like, or would look at, and if you can do this and do that, that would make it easier for you both to obtain your goals?
Yes, that's correct. The question was, if we as a lender, come in and give our opinion on what those amounts should be, correct? That's what you're asking, what the amounts of child support and alimony could potentially or hypothetically be in order to help achieve a certain outcome.
In the context of their FICO scores and their incomes and all those other things that the lenders look at, you're saying, if you can put these numbers together, you're in better shape to get qualified or to do whatever it is you're hoping to do.
That is correct. Yep. So use us as a resource. Use your attorneys. Your attorneys have a wealth of information, and they're there. They're in your corner. They're there to help you out. And hopefully, as stressful as divorce is, some common ground can be met when a third party comes in and offers a professional opinion. So that's what we're here for. Any other questions regarding that?
Well, in our case, both me and my soon-to-be ex-wife have our names on the mortgage.
Mm-hmm.
They're trying to award me with the house, which is upside down.
Okay.
Of course, they're awarding me with it because it's upside down.
Yeah.
But that's okay. And I've gone into Chapter 7, so I'm protected from that. And I'm living there until the lender decides what we should do.
Did you reaffirm on that debt?
No.
That's all included. Okay.
Right. And I guess my question is, now that I'm under that umbrella,
Mm-hmm.
there seems to be 7 or 8 different options that the bank who owns the house could choose. And it's not that I want to lose the house, I want to renegotiate, but at the same time, I'm not going to negotiate a settlement in my divorce that I'm unhappy with when it comes to child custody. So I'm in this, difficult place in the middle where
Yeah.
I'm not gonna give up on my children, but, I'm gonna stand in there as a dad, but at the same time, I wanna know what the bank is, so we're kind of like just stuck in this place,
This is where divorce gets very, very complex. And for the video, the question is, he and his soon-to-be ex-wife are both on the mortgage. He's been awarded the house, and it's upside down. There's no equity, so he's awarded the liability. The question is, he has filed a Chapter 7 bankruptcy. How does that play through? What are some of the options
and I
there?
have been discharged, by the way,
Oh, it has been discharged. Okay. How long ago was it discharged?
in January.
Okay. So there's a couple things here that I need to mention. The home was discharged 3 or 4 months ago in the bankruptcy. The foreclosure has not been executed, correct?
That's right.
Okay. So you have several layers here, and unfortunately this is a very common thing that we see. You being the good dad that you are, you're trying to keep that stable for your kids, and I totally respect that. You've been put into a tight position, and your options are somewhat limited. Has your attorney, I guess if it's all been through and discharged, here's the thing, on a bankruptcy, you are discharged from the debt, from the obligation. You no longer have that in a Chapter 7 bankruptcy. The challenge is you still own title to the house, and you own that until they execute on a foreclosure. And there's a very, very specific process that lenders have to follow to be able to exercise their foreclosure right. Now, for you, when you go to requalify for another mortgage, and they may choose to modify, they may choose to keep you in there because Fannie Mae and Freddie Mac, they already have millions of homes still on their books. There's still homes in shadow inventory, that homes that are unattended or vacant fall into disrepair, vandalization. They have all sorts of problems. So it's really in their best interest to keep you in that house as long as possible. Here's the disadvantage. Your credit will continue to suffer until that foreclosure is executed. And let me explain why. We have a gentleman that went out, put a deposit down with the builder. He was 3 years out of his bankruptcy, which is plenty of time to go ahead and qualify for a new mortgage. Those dates, just so you know, range between 2 years and 4 years before you can qualify for a new mortgage, depending on the program. And there are some exceptions to that. So he went, built this beautiful new house, went to apply for a mortgage, and provided us the documentation on the bankruptcy, and we saw the foreclosure on there. When we pulled the county record on his old home, the foreclosure didn't happen till a year after the bankruptcy was discharged. Well, foreclosure has a longer waiting period than bankruptcy does. If it's part of a bankruptcy, they'll go off of that, but we need at least 3 years from the date that the foreclosure was fully executed before you can apply for a new loan. Not just qualify, but even apply for a new loan for it to be considered. So you have a few layers in your situation, and unfortunately a lot of people are in the exact same boat. And so keep in mind, when you go to purchase another home, make sure your loan officer, your consultant, whoever it is you're working with, understands those date differences, because not every loan officer knows those date differences. So just be aware of that. It's going to go off of the ladder of the bankruptcy discharge date or the foreclosure date. And there's different timelines waiting for each one. So this brings up a couple questions. What can you do to reestablish credit quickly? Whether you're at the beginning of a divorce or you're at the tail end of a divorce, whether you're not even getting a divorce and you just need to get your credit fixed, there are several things that you can do to help increase your credit score quickly. The first thing, pay your bills on time. That is the most important thing that you can do, even in a divorce. Even if stuff is getting heated over the house or over credit cards, please do everything you possibly can to continue to make those payments. If credit is something that is important to you. Yes?
When I was going through my initial divorce, my attorney at the time advised me, don't pay anything, just make sure I get paid. Now, you know what I'm saying?
Yeah.
Yeah. Said all these other things will come around eventually. So we did go through bankruptcy. You know, focusing on what was supposed to be protecting your kids and your relationship. So I don't know if there's a question that's just kind of a situation that I found myself in.
So maybe the question should be, what do I do if my attorney tells me to not worry about my other payments? You know, it'll all iron itself out. I guess that's something you have to decide as you work with your attorney. I will never tell anybody not to make their payments. I can't do that. That goes against what my job is. You know what I mean? And I think it depends on what your ultimate end goal is. Best policy, best practices is to continue to make your payments, if at all possible. And in some circumstances, where there's huge medical debts, I mean, there's always exceptions, right? And each person's individual circumstances will help dictate what the best course of action is. But generally speaking, continue to make your payments if at all possible. From there, another thing that you can do to increase your credit scores very quickly, lower those balances down on the credit cards that you have. Yes, question?
So would that mean lower them by selling off stuff and just selling everything to the bare walls and then building back up to having some of the nicer things in life? I mean, because it's one thing easier said than done, I guess.
Definitely easier said than done. The question is how to accomplish that, how to accomplish lowering those credit card debts. First off, stop using them. It may take time to pay those down. Ideally, get below that 50% balance versus limit. That will start your scores going up quicker. Can you sell stuff to accomplish that? Absolutely. Are there other ways, even considering looking at 401ks or retirement accounts? Those are options as well. There's always tax ramifications, so I would advise you to talk to your accountant on stuff like that. But coming up with a solid plan to eliminate that debt and sticking to it. Looking at your lifestyle, looking at what changes can be done to lower those costs. Yes, another question.
What about lowering them by talking to the or the creditors themselves? Does that accomplish one thing good, but then cause a negative consequence score-wise?
The question is, if you were to call and negotiate a settlement with your credit cards for less than the amount owed. In certain circumstances, that can be beneficial. In other circumstances, I mean, it is going to affect your credit negatively. And let me explain why. Most credit card companies will not negotiate for less than the amount owed unless you are already behind on your payments with them. If you're behind on your payments with them, that's not a bad strategy. Your credit's already been affected adversely, and it's a great way to lift that burden. So that's certainly something that can be considered. But you would have, to even consider that, you would have already been late. Yes.
Is there a sweet spot then where you're saying I'm already behind, so I might as well try to get as much of a settlement with the credit card company as possible? Or am I bad enough falling behind, and then do I make it even worse credit score-wise by settling the debt? Do they get to report that as this guy's a double deadbeat kind of situation?
So here's my opinion on that. The question is there a sweet spot, or is there a point where it's beneficial to do that if you're already behind on payments? The answer to that is, again, each person's specific circumstances are different. Is that more advisable than bankruptcy? Absolutely. Because if somebody's been late on a credit card payment, I can get them a mortgage with 12 months of clean credit history versus waiting 2 to 3 years on a bankruptcy. So yes, in certain circumstances, that could be beneficial. But you have to look at the full picture. So to have a standard canned answer is not something I can give. We just have to look at your circumstances. Yes?
Just a quick question, more hypothetical. Now on there you said 12 months of clean credit history. So say you have a credit issue and you lower your balances, you get them below 50, you pay your bills on time. So is it about 12 months that you can look at that you can start considering applying for a mortgage again?
Generally speaking, the question is, if you're current on most things, you may have had a couple late payments in the past. Generally speaking, 12 months of solid payment history is what they're looking for. Okay. Now, there's always exceptions to that rule. Medical collection accounts, stuff like that, do not weigh as heavily as a 30 to 60 or 90-day late payment would. So there are exceptions. As far as mortgage lates are concerned, there is no exception. So we have to have a 12-month clean payment history. Now, back in the day, in the subprime days, it didn't matter. If you could fog a mirror, you could get a mortgage. And we're actually seeing some first signs of subprime mortgages coming back, but they are much more restrictive than what they were before. So the banks are starting to loosen the purse strings a little bit. Some of the credit requirements, for a long time, if you didn't have at least a 640 credit score, you couldn't get a loan. We can do loans down to a 600 FICO score now. So there are options. Veterans have some special privileges, some special programs. Even after divorce, if you're looking for down payment assistance programs, there are those programs out there as well. Whether it's for you or for your ex-spouse, there are programs that we can consider. Even different types of employment, police officers, nurses, doctors, firefighters, there are special programs for them as well. So
your credit score, mine's over 850.
Okay.
But does it matter? How far, where's the point when it does matter? 650, you said?
Okay, as far as credit
Well, I mean, is it that important to have it so high? Is it, I mean, could it be a 700, still be considered excellent?
Great question. So the question is, what FICO scores are considered good credit and where's more challenged credit, perhaps? Anything 740 and above is considered excellent credit. It makes it super easy to qualify for a mortgage. Now with, depending on the type of financing, conventional financing, once you start dropping below a 700 FICO score, it starts to get a little more challenging. And the lower you go, the more difficult it is, and the higher the interest rates are. Yes, a question?
So what about if I get like child support and alimony, but then my ex, my husband, doesn't pay on the time, he doesn't pay, like he's not consistent?
Okay.
Is that gonna affect me getting a mortgage or qualifying
Okay.
for a loan?
So the question is, if I'm receiving child support and alimony, I've been awarded it, but I'm not receiving it, does that affect my credit, and then does that affect me qualifying for a mortgage? If you're not receiving it, it doesn't affect your credit. It only affects your credit if you're the one obligated to pay it and you're not paying it. As far as qualifying for a mortgage, if you have another job, another income, you may or may not still qualify. On a mortgage application, one of the questions is, are you obligated to pay alimony or child support? And by law, you have to answer that. Another question is, do you receive child support or alimony? You do not have to answer that question if you're receiving it. You only have to answer that if you want to use that in helping to qualify for a mortgage. So for spouses that are receiving it, the key there is the continuance, right? And consistent payments. We have to be able to verify that. Jumping back real quick to your question on credit scores. Government loans, like a veteran's loan, or an FHA loan, or a USDA loan, those are much more looser on credit requirements, and you don't see the interest rate adjustments with the government loans to the degree that you see them on conventional loans. So,
But your credit score is very high. That doesn't win you more points with issues like income, expense ratios, and that kind of stuff.
actually it does. It does indirectly. So the question is, does the credit score affect qualifying with regard to exceptions perhaps on higher debt ratios? And the answer to that is yes. The higher the credit, that's a very large compensating factor for them in looking at debt ratios. If you have horrible credit, they're going to be a lot tighter on debt ratios versus somebody with an 800 FICO score, that they may allow an exception to go up to a 50% debt ratio, or perhaps even a 55% debt ratio. So there are some definite benefits in having excellent and high credit scores. So does that answer your question?
Yeah.
Okay. Yes.
So what happens in a case like we have joint debt, joint credit cards and items that we acquired together? He agreed that he was going to make those payments, but he's not. So how is that going to affect me? Or what should I do now?
Okay, so the question is, if we have joint accounts and somebody has agreed to pay those but they are not paying it, how does that affect me? The thing is, you are equally yoked, equally obligated to any debts, whether it's a credit card debt, whether it's a mortgage payment, car payment. If both of you are on that account, you are both equally liable. So if the ex-spouse, husband or wife, doesn't matter, does not make the payment, you're both affected adversely on your credit scores. Even if in the divorce decree it says, John Smith is liable for this credit card, and this car loan, and Jane Smith is obligated for the house. It doesn't matter who is obligated on the divorce decree. If they are both still on that credit account, they will both be affected adversely.
What if my name is not on her credit card?
Okay?
Doesn't affect me.
Does not affect, if your name is not on the account, it does not show up on your credit. You're not affected if the payment is not made. Does that make sense? And that's from a credit report perspective only. Now, is there liability? That's something that would have to be negotiated through with the attorneys. So, does that make sense?
Well, we have multiple accounts, joint accounts, credit cards, but nothing is owed on these.
Okay.
Is there an advantage now, before a divorce is final, to get my name off some of these accounts?
Yes. The question is, if I have multiple credit card accounts that we are both on, but there's zero balance, is there advantage to getting off of them now? And the answer is yes. Just because there's the potential that the other spouse may go and rack up debt and not pay it, and you'd suffer the consequences. So in the divorce, it's best to separate all accounts, if at all possible. And some of that may have to be settled for less than the amount owed. But whatever you can do to get off of those accounts, to free yourself from the potential obligation, the better. Yes?
So my husband and I are both currently in the mortgage,
Okay?
on the loan. We got it together. So my question is, how do I buy him out? Can I buy him out? I want to keep the house.
Okay.
So what are my options
Great question.
in that case?
So the question is, both husband and wife are on, yes?
The interest rate that I have, it's great right now. So if I could
Okay.
just keep the same interest rate, same loan terms, and I just want to keep the house.
Okay. So both husband and wife are on the mortgage. They have a great interest rate. She wants to keep the house and the husband does not. How does she buy him out of the equity? How does she take over the mortgage? The only way to do that is to refinance the house. Very, very, very rarely would a bank ever release somebody that's obligated to the loan, because they want to be able to go after anybody should the home ever go into default. So really, truly the only way to get that done is to refinance it. And if that means that a portion of the equity is paid to the other spouse, hopefully they qualify for that. But if not, that may be something that you have to go back and renegotiate on.
What if you're willing to give up your equity?
If you're willing to give up your equity,
Give up your equity, and would that help her qualify?
the question is, if one spouse is willing to sacrifice their interest in the house and their equity in the house, if that would help qualifying. In many circumstances, yes. The bank looks at every loan from a risk perspective. So the lower that loan to value is, the lower the risk is for the bank. And in this particular case, it would help the spouse's debt ratio to hopefully be down lower as well. So the answer to that question is yes, it would definitely help. So
along the same lines of the lady's question, if indeed, would a bank release the other party if maybe you negotiated having an insurance policy in place for the remainder of the balance for the life? That lowers the risk, right? And you'd have to, of course, prove that you're maintaining this life insurance policy. And would that allow, do you think that would affect the bank's decision?
So the question is, if the spouse that is leaving the property, if they were to have an insurance policy.
The spouse that keeps the property would get a insurance policy. Would they release the spouse that is leaving? Because that would reduce the risk to the bank.
So the question is, would the bank release the spouse that's leaving if the remaining spouse had an insurance policy, like a gap insurance policy? The answer to that is no, they would not. So, like I said, in very, very rare circumstances do they ever release somebody that's signed on the line.
What are those circumstances? Just so that people know that you don't have a snowball's chance in hell of being one of those.
What would those circumstances be? I'll be honest, I have never seen one in my life.
So that's how rare.
I would say it's something along the lines of fraud, which they would call the note due at that point anyway. But that would honestly be the only thing I could think of, is if it was some fraudulent transaction. So, any other questions? You guys have great questions. So, anything else on credit? Okay. Well, thank you again for coming, everybody. We'll post this so people have access to it. You're always welcome to call Eric for any consulting questions that you have regarding divorce. You're always welcome to call me. My name is Ben. I'm happy to help you with any mortgage or finance questions.
Great, thank you, Ben.
Yeah, thanks for coming, you guys.